Hey everyone. It's a pleasure to be here today and to come back to IFGS and almost always have the privilege to talk about innovative ways of funding the future, which I know has been a big piece of today's theme across IFGS. And it's particularly exciting for me to be hosting this panel together with some brilliant panelists here and talk about where we are on the road to net zero, and especially as we think about investing in climate resilience and adaptation. Accurate, we are interested in solving the structural problems that will scale the carbon removals market, and we do that by de-risking, buying and investing within the carbon removals market through science-led diligence as well as technology. But most importantly, I think we are also interested in driving incentives to invest in this market now. And that becomes the theme of what I wanted to discuss today in this panel. The Bank of England in 2021 put out a statement that said climate-related risks will affect every consumer, every corporate in all sectors and all geographies. Their impact will be correlated, non-linear, irreversible, and subject to tipping points. And so it's quite crucial that we start thinking about building in climate outcomes into business as usual. It incorporates, and while incorporating these risks, solve for two things: maximizing climate outcomes, but also solving for social and environmental justice. And what I wanted to do today is chat about incentivization and how we actually build in appropriate interventions to achieve these climate outcomes. So I'm going to run through all of my brilliant panelists and ask them to introduce themselves, say who they are, what they do, and what organization they're from, and then answer this question through all of their different perspectives on climate outcomes.
Right. Thank you very much, Swarnali. My name is Gbenga Ibikunle. I'm a professor and chair of finance at the University of Edinburgh, which means I'm an academic. So basically, my primary responsibilities are to conduct what could hopefully be construed as interesting and impactful research, and also to teach at the university. And as an extension of that responsibility, the research responsibility, I also lead an interdisciplinary research center, the Edinburgh Center for Financial Innovations, and it is a flagship research center at the FinTech Research Center at the university. And what we do is to conduct interdisciplinary research that is co-created with external partners. So basically, every research project that we engage in is challenge-led, and so we're trying to address the biggest challenges that face society. And one of them touches on one of the projects that we're working on touches on the topic we're discussing today, which is how we might incentivize people to consume less of emission-intensive products and services, and by so doing, help us get to a net zero trajectory faster and to help us achieve a more just future. So at the center, we have 43 research active academics. We also have 7 PhD students who are fully funded. So they are working on projects with external partners that have been carefully curated to address specific challenges that will be beneficial to society when they are addressed. And we also have a slew of research assistants working on all these projects. And in the next few months, we expect to welcome a couple of postdocs who are also going to be working on these challenges. So, as I said earlier, one of the challenges we're working on is how we might incentivize people to reduce their consumption of emission-intensive products. And climate change is an unusual externality in the sense that it is irrelevant whether I am a subsistence farmer who lives in northern Nigeria, who is just trying to make do and trying to survive from one day to the next, or I'm a jet-setting academic who flies in from Edinburgh to London today to speak on this panel and then return to Edinburgh later this evening. It's irrelevant. There is a cost to climate change, and I am going to pay it in some way, and the subsistence farmer is also going to pay it in some way, despite the fact that this farmer contributes very little to the stock of greenhouse gases in the atmosphere. And one way for us to address this imbalance, this market failure, which is astonishingly unjust based on its structure, is to try to generate a price signal that will show what the cost of abating 1 ton of CO2 equivalent or a unit of emission that I am generating, or the farmer is generating, or all of us are generating, and then find ways to make us pay for that. And that will be after, of course, we've adjusted for giving some free allowances for everyone. So basically, as you will have your taxes, you have tax-free allowances, and we will have those for such system as well. So what we are working on at the university at this point, at the Edinburgh Centre for Financial Innovations, one of our projects is to find a way of generating this price signal at the household level, at the individual level, in a way that it is quite clear what the cost of every product that you're consuming is to you, not just from the economic aspect, but also from the environmental aspect. So we are focusing on transforming this old approach of cap and trade systems, emissions trading schemes, which are usually placed at the upstream level in an economy. And it makes sense to place it at the upstream level because companies are better able to bear the cost of monitoring, reporting, and verifying the emissions. So it makes sense to do that. So a lot of policymakers have taken that approach over the years. We have the EU emissions trading scheme, which is a very large one. We have the UK emissions trading scheme, we have the Chinese emissions trading scheme, and about 7 pilot emissions trading schemes before that. So the problem with this approach is that when people buy products, the idea is that if you tax companies, if you make them pay for the emissions that they are creating, then they will pass that cost through to individuals, and individuals will substitute away from emission-intensive products because they will become more expensive. So the problem with this is that there is a chance for misattribution because people are seeing only one price when they buy products. They're not seeing the part of the price that is linked to the emission content or the carbon content of the products that they're buying. So what we're trying to do is to devise a system that makes this less murky, to remove the misattribution. And we are also going to deal with the MRV problem, the monitoring, reporting, and verification problem. And there are companies that we have been engaging with. One of them is Kogo, that they combine emission factor databases with transactions data, and they are using that to compute the emission intensity, emission content of each transaction that someone undertakes. So I think this is the way forward, and we're still in the early stages, and we believe this will be a significant contribution to addressing the climate change problem and to get us to net zero.
Thanks so much, Gbenga. I love that the way we're going to answer this question is through different hierarchy levels of organizations, the market, as well as someone that's right at the center of public and private affairs. Jamie, would love to hear from you what the impact investing
Sure, I'd love to elaborate on that. So I'm Jamie Broderick. I'm Deputy Chair at the Impact Investing Institute, which we set up 4 years ago to promote the flow of capital into investments that are creating a social and environmental benefit alongside a financial return. One of the key themes of our work is the just transition. So our view is that basically it takes you beyond green. The just transition says you won't get to a transition to net zero, a low carbon economy, unless you also capture the social dimension to that transition, and preferably by consulting with the communities that are impacted. So the just transition is a big theme for us. One of our early successes was we were part of a coalition that convinced HM Treasury to finally issue a green bond, which they had resisted for a long time. Our particular contribution to that was to get them to issue the green bond with accountability for the social co-benefits. So for the first time in a sovereign green bond, the social co-benefits were incorporated in there. Because our view is that it's just not going to happen unless you capture the social dimension. And so I think when, innovation around climate isn't always about the science, and it isn't always about the financial engineering. It's also about creating the social dimension, capturing the social dimension. I'll give you a couple of examples. So the first, which you all be familiar with, is the attempt by the French government in 2018 to impose a higher fuel tax. They did that without capturing some of the nuances you were describing, Gbenga. They did it without capturing the impact. It's effectively a regressive tax. The impact on farmers, on lower income communities, on commuters, on people in the suburbs who rely on their cars. They didn't capture that, and the people then put on yellow vests and basically forced the French government to back down. Now, the government could have done it differently. So if you ask an economist, how do you suppress carbon? The answer is make it expensive. That's true, but you have to make it expensive in a thoughtful way, along the lines you were describing, I think. And they didn't do that. Now, British Columbia, for example, has priced carbon. They've made it revenue neutral, which is to say that they take the additional money from the carbon tax and then return it as in the form of a carbon dividend to the citizens. So I think that's one of the ways in which you think through how is this going to impact people. So that's one example. A second example is onshore wind. Onshore wind is basically a no-go area in England. So England over the last 10 years has installed 15 wind turbines because it's almost impossible to get it through the planning process. Now, my family comes from the US state of Iowa. Iowa is exactly the same size in landmass as England. In the last 10 years, they've put in 3,000 wind turbines. Now, climate change is a dirty word in Iowa. It's a red state, what we call a red state. And so they don't talk about climate at all. It's about the jobs, it's about investment, it's about taxes. So the communication with the people is really what's caused that to happen. Now, the energy bill, the energy bill from last year was revised to now allow local councils to take into account the aggregate of community sentiment, which broadly is actually more supportive for onshore wind than you would think. So 43%, the Department of Business and Trade did a survey 2 years ago. 43% of people are okay with a wind farm in their neighborhood versus 12% who were opposed. Slightly better for solar. So there is sentiment, but what you have to do is capture that sentiment, cultivate that sentiment, bake it into the policy, which hasn't been done. And so then you get wonderful ideas like Octopus's fan club. So the fan club takes 20% off your electricity bill if you take it from a in-community solar wind turbine. And then if the wind's blowing strong, you go down to 50%. So there are innovative ways to think through. We want to put up turbines onshore, but we want to capture the sentiment of the individual people. And the final thing I'll mention is retrofit. Retrofit is notoriously difficult to do, but in fact, the technology to do retrofit is there. Even the financing, you can kind of almost get there with the financing. But the problem is that people just don't, even if it's zero cost or low cost, they won't do it because it's very disruptive. So the innovation there is net zero neighborhoods, in which an entire neighborhood comes together and creates a neighborhood momentum, neighborhood feeling, pressure on, peer pressure, peer inspiration. And what you do is you combine it with a whole series of interventions, not just retrofit, but also bike paths, pedestrian paths, air quality. You build together more parks. You build together an entire value proposition for the community, and that's the context in which you do residential retrofit.
Thanks so much, Jamie. I especially am obsessed with finding practical examples of how things work, because incentives and creating incentives don't necessarily latch on if you don't have big organizations and big names actually doing it. A lot of what we do at Curators think about building these incentives that then can be translated across the public-private dimensions. We've worked with the likes of Standard Chartered Bank very recently, British Airways, as well as the royal family, to try and demonstrate, similar to what Jamie was saying, what the value attribution is of doing anything within the climate outcome space. And I suppose, Nina, what I would love for you to share with the audience is how Volition's actually doing this on a very practical level, and especially for the asset managers in the room. I think this is a very, very brilliant example.
Absolutely. Thank you. I'm Nina Foote, partner and head of growth at Volution. At Volution, we invest in early-stage fintech and SaaS companies, so companies that enhance the efficiency of the capital markets, workplace productivity, and financial inclusion. We're not climate investors, we're not green investors, but as investors, we believe we have responsibility to encourage the companies that we invest in to become more sustainable and more inclusive. At Volution, we invest within the funding gap that we see between Series A and Series B, the most challenging phase for a founder on their scale-up journey. And as a group of investors, former founders and operators, we're very keen to have a hands-on approach supporting the portfolio companies that we invest in. And we believe that ESG is an essential part of this. For us, ESG transcends compliance. It's a fundamental value. It needs to be built into a company's ethos right from the beginning and to be part of their strategy for growth. At Volution, we've had a sort of a four-stage approach to how we engage with our portfolio companies in terms of driving ESG. First is engagement with them. Sorry, let me find my place. We have 4 stages, and the first stage is setting the example. There we go. We set the example, then we have a framework, then we have education and a resource hub, and finally we have incentives, and that's really what I want to talk about. So first of all, setting the example. We at Volution, we work very closely with ESG VC and Venture ESG. These are groups of investors who come together to try and find solutions to some of the problems in early stage businesses around diversity and around climate change as well. So we then put the policies and procedures in place within our fund. We have, for example, initiatives to promote diversity within the industry. We also have measured our own carbon footprint. So we set the scene and showed what was possible, even for a very small and lean team. We then have the framework. We didn't want to start from scratch with a framework. We wanted to use something that was going to be easy and accessible for our portfolio companies. So we used a framework which is developed by ESG VC, and it has 48 questions across the 3 pillars of E, S, and G. And the companies fill out this at the point of investment. We also have a term sheet clause, and they fill this out at the point of investment and then on an annual basis. So when you get the results of the survey, you can see how they're making progress against themselves on an annual basis, but also compared to our portfolio. So we have an annual ESG report, and then a wider industry report. So this information goes to the BVCA, and then companies can see how other companies are doing at the same stage and same sector. And I think that's very, very powerful. Then it talks about resources. So we have an ESG hub that we give access to our portfolio companies. So we share resources, we have lists of suppliers, we have articles which they might find useful, just information that might help them on their journey. And we also share details of webinars which might be helpful for them along their journey. And finally, we have the incentive scheme. And this was really us trying to align the portfolio companies with our values. And the way it works is we use the framework, and if our portfolio companies hit certain ESG milestones, we will reward them with ESG carry and carbon carry. ESG carry is a financial reward, and the carbon carry is the environmental reward, where the money goes directly to carefully vetted carbon removal initiatives. So for us, why are we doing this? We want to bring our companies along. We also know from the reports that have been put out already by the BVCA, and we see it ourselves, that the companies that we're investing in, they're already thinking about the governance side and the social side. Clearly not quite enough after you've heard some of the panels here today. But these are fintech regulated companies, so they have to be thinking about governance from day one. And on the social side, if they want to attract and retain talent, they really have to be thinking about what kind of policies and practices they might have in place, whether it's flexible working, parental policies, all of these kind of things. Several of our portfolio companies, as an example, are members of the Tech Talent Charter, so trying to broaden diversity within the industry. But we want to shine a light on the environment because they're not performing as well in terms of the environment. Tech companies, fintech companies, do not really see themselves either as the heroes or the villains of the environment. But actually, we have to realize that the ICT industry is now responsible for somewhere between 2 and 4% of global emissions. And this is a huge amount. And so we're really trying to incentivize them to think about the environment. And it's a call to action, a starting point for a conversation and a blueprint for integrating ESG within our portfolio company operations.
Thanks so much, Nina. I know we're out of time, so I will leave everybody with 3 things. One is climate change affects us all, remember that. 2, there is the art of possible, which a lot of people over here today have demonstrated. So come talk to us. And 3rd is blending it into BAU and creating clear incentives is the way forward. Thank you so much for listening. Thanks, everyone, for your time.